Hey, everybody, they did it again. OPEC this morning announced another production increase. Now they're looking at bringing back barrels that they took offline all the way back in April of 2023. I don't know. I think it's bearish for now, bullish for later, but keep watching and I'll explain. Hey, I'm Aaron. With 30 years of experience in oil trading and analytics, I'm here to elevate your understanding of the oil market. So let's jump into it. All right, let's start our slide pack for this week. I'm going to go ahead and start off with some quick notes I took on this morning's OPEC meeting. So there, as I mentioned in the intro, they're trying to bring back 137,000 barrels per day, month on month for the month of October. So they've already returned, according to the headlines, the 2.2 million barrels per day that they took offline voluntarily back in November of 2023, and now they're looking all the way back to April of 2023 to try to take those barrels off the market. So, that would be, obviously pretty interesting if they were able to do that. And that's sort of what they, like I said, they've got their sights focused on that. October will be the first tranche of trying to return the 1.65 million barrels per day. So the group in their statements still say they see, good economic outlook. The market's healthy, inventories are low. They remain cautious and flexible, implying that if something were to happen, they'd take barrels back off the market again and try to stabilize things a little bit. So I don't know. We'll see if that happens or not. And they're still talking about going after members who overproduced since January of 2024, trying to rein that production back in and let others grow. So you might read that as increasing market share to Saudi Arabia, who's been especially strict this whole time in how much oil they produce and how much oil they send out to the market. That's sort of how I read that anyway. The next meeting will be on October 5th. And again, so due to the guidance given today, we would expect another, 140,000-ish barrel per day increase for the month of November if they, would continue to go on. I put in this chart here. Hopefully you can see the top line is Petrologistics production numbers for the 8 OPEC members who, carried out this voluntary cut and trying to bring things back. So as I've been saying this whole summer, the production numbers tracked by Petrologistics, they actually go back and they check the vessel data. They see where things are flowing. They check pipeline flows and that sort of thing, and sort of net that all back to a production number. That's been much higher than what OPEC has been claiming sort of internally. So this blue line is if you went back and looked at all of their press releases due to these, where each month they're meeting and they're announcing all these increases in production. They do give you a little table where they say, here's the production target for each month going forward. So that's what this blue line represents. And what I think is interesting now is the October, if that's realized with their 137,000 barrel per day increase, is within 500,000 barrels of where we are sort of in real time here at the, for the end of August. It's only September 7th. So I think August is probably about as real time data as we can get on this sort of scale. So the argument that OPEC has been overproducing the whole time and just using these headlines to, bring us back into sort of compliance where production has been all summer is obviously gaining weight, as the difference between this August number and this March number, according to Petrologistics, is only about 250,000 barrels per day difference. Obviously, in June, you got a big peak. Back here in May, you had a pretty low number. So there's been volatility over that time, but sort of March to August has been a relatively small increase, whereas the headlines from OPEC would have you believe there's been this huge increase. But if you watch last week's episode, I go in and talk about the OECD inventories and all that sort of thing. So go back and watch that. I think I'll put a link to it here somewhere. So please look for that. So moving on, we're going to start looking at the WTI chart. That's what we normally start out with, but I thought that breaking news trumped it this week. So super interesting. On the weekly, we sold off to this support line again that we had drawn quite a while ago. If the market were to break this support line, the next sort of big support number is this 55, which it's hard to see maybe on this chart, but that's the lows that we saw back here in this time frame. We had a day or two where the market bounced down to 55, and actually, if you go back and look at drill in on that data, it was really only 10 or 15 minutes each time at that sort of price range. But to me, that would be the big downside target. It looks like obviously there's probably some support right around here, just under our trend line as well. But I think that's something to watch out for in the bigger picture. Again, looking at the weekly to get a sort of a bigger macro view of what's going on. Um, I guess the other thing, just to go back real quick, the other thing that's interesting is the last few Fridays we've had down days. I think I talked about this in last week's episode. To have a sell off in the market on the Friday before a 3-day weekend is really pretty strange. It's pretty rare. We got a big sell off on Friday of this week. Well, because there was OPEC headlines sort of hinting that they would increase production. So I think that sort of makes sense. But for a long time in the market, there was what we called Friday buy day, right? Where it didn't matter what happened. The market was just going to rally on Friday because no one wanted to take the risk over the weekend. And that's probably going back all the way to the kickoff of Russia, Ukraine, and all those sorts of tensions, and then heightened by the Houthis, blocking in the Red Sea and that sort of thing. So as those issues have sort of maybe simmered down a little in terms of their influence on the oil markets, I think it's interesting that like mentally we're making this transition now to where the market maybe feels a bit heavier, which is why I think we have a shot sometime in the next 2 months at getting down to this $55 range again. And then in my mind anyway, that would be a pretty good place to buy, because I think it'll be fairly bullish from there. So just to kind of go through that a little bit more, there was one headline this morning that said OPEC wants to bring back that 1.65 million barrels per day by August of 2026. So that would be all the voluntary cuts sort of taken back, or all those barrels put back in the market by August of 2026, which brings us to an interesting point. So for the October numbers, the OPEC, that I told you about, that table that they put out, OPEC put Saudi Arabia at 10 million barrels per day, which is a little bit of a flag, because above 10 million barrels per day, people start arguing about, well, what's the spare capacity of Saudi Arabia? If you extrapolate that on and go all the way out to August of 26, let's say OPEC continues with their increases, and then they return, all 1.65, at least in the form of headlines, to the market by the middle of or late next summer, then we're going to get back into that argument of, well, there's not much spare capacity. So if during that time global demand is actually pretty good and global inventories stay relatively low, that would get you, so those are two kind of big ifs we have to get to. But if those two ifs are satisfied, that gets you to another pretty tight market position now, where you're saying, well, OPEC no longer has the spare capacity, or their limited spare capacity, right? You're really funneling down what they can do on a broad scale to supply the market. At which point market prices have to go to where you get the how do you say this? The more, like all the US companies or the European companies that aren't sort of led by governments to try to change things, the entrepreneurial capitalistic companies then have to be incentivized to go out and drill more oil. And you have to obviously give them the right price signal to make that happen. So in that scenario where OPEC were to bring back 1.65 million barrels per day by August of 2026, and the market still feels tight, demand still looks good, inventories are still low, then that has to be bullish at that time, because you have to incentivize deep water, you have to incentivize US shale, you have to incentivize all this other production going on around the world to try to make up for that. You're kind of capping off the Middle East. And of course, Middle East can grow as well, but we've just had these arguments, academic arguments going on for years and years about what the actual maximum capacity of the OPEC member states are. And of course, OPEC and Kuwait and Iraq loom very large in that conversation, because those are the big producers. At the same time, if the Russian sanctions are still in place by August of 2026, then that would maybe continue to uh, deter their ability to increase exports to the rest of the world, to increase production to the rest of the world. So there's almost a bullish silver lining, if you want to call it that, coming out of this. Where I think we still have to go through, in my mind anyway, we still have to go through a season, a bearish season, but that almost makes the summertime of 2026 more bullish. Okay, and that again, that depends that the demand has to still be there at the end of that time, but anyway, that's how I'm thinking of it. But let's keep going through the slide deck here. So the monthly numbers came out from the EIA. If you recall, the monthly numbers are much more robust in terms of the DOEs actually going through and tracking this much more closely. The weekly numbers are pretty good. They give us a good indication, but especially on the demand side, weekly numbers are calculated. Weekly demand numbers are calculated. So they know what the change in inventory is. They have a good idea of what supply is, which means you can calculate what demand has to be to make those other two hold true. That's why I'm saying the demand numbers, especially from the monthly reports, are especially important. So you can see total liquid demand, not quite a new high, but very high. We've had higher levels here and here off of these peaks, but we're at very high levels, especially for this time of year, for the month of June, which is the most recent data we have. U.S. exports of total liquids a little bit lower than a year ago, so that's somewhat helping in terms of that total demand number. Exports are off a little bit versus where they were last year. Then I break it down a little bit more in the domestic demand. So U.S. domestic NGL demand, so include propane, butane, all those sorts of things, actually pretty strong. We got down to year ago type levels after, cold winter certainly helped in the beginning on the propane side of things, but now we're starting to really accelerate above where we were this time last year and well above where we were 2019, the pre-COVID numbers, if you will. And then the transportation fuels, we're also doing pretty well above year ago levels at the top of the 5-year range, couple, 1,000 barrels per day below the top of the 5-year range there. And still, a decent chunk below the 2019 levels, which given innovation, given EVs, given efficiencies in vehicles over the past 6 years, between 2025 and 2019, that might be expected. So that's maybe not a terrible thing to go on. But I think it's definitely worth noting we're right at the top of the 5-year range still. As far as inventories go, we're starting to see, especially in Pad 2, where we've got some refinery issues going on. We've got some planned maintenance going on. Inventories are starting to back up. And this is what I was talking about last week. This is maybe like zooming in on a very small example of what we expect on a large scale, is once we get into turnaround season, crude inventories anyway should actually increase pretty quickly. And so what I'm trying to show here is Cushing, which is in Pad 2, is a sort of a subset of Pad 2, but it's the delivery zone for the NYMEX crude contract, which is why it's super important. We're still below the 5-year range. We did get a build this last week, and we're not too far below year-ago type levels, but, obviously still low. But if you take Pad 2 minus Cushing, you're left with Pad 2 stocks outside of Cushing, which makes a lot of sense that we'd see inventories grow in that region because it's, the Chicago area refiners that have sort of been hit and been having some planned issues, and further east in Pad 2 that's having some planned maintenance going on as well. So all of a sudden we've gone from being at the bottom of the 5-year range to being at the 5-year average pretty quickly. And so I just wanted to point this out really quick. I thought it was interesting that we were able to build stocks so quickly. And this is a good illustration of what I have been talking about in previous weeks on a global scale. As we go through the global refining turnarounds for the fall, we should be able to see crude inventories grow. And then what happens from there, if you can see, like Cushing last year was interesting because we had a pretty strong refinery demand at the end of the year going through Q4. So Cushing inventories last year, had this little bounce back as we did some maintenance. And then as you got through November, December, they actually fell. However, the 5-year average would say you continue to see volumes increase slowly throughout the end of the year. So a little bit undecided on that front. You can see how it can go two different directions there. But on the whole, we would expect, inventories to go up if you see the 5-year average kind of grinding up, or just even from the low point of, pad two stocks outside of Cushing at the end of September gradually built to the end of December last year. All right. So on crude production, we also set a new high this year. 13.58 million barrels per day is a new high number. A couple interesting things, though. If you look at sort of the rate of change, we're increasing much more slowly than we had sort of in previous years where we had very strong production increases. So, yes, we set a record high. We're kind of taking our time to get there. We started with a very high base in December, November, December of last year. So we started from a high position. We're just kind of slowly grinding that higher. If you look at the net production, so what net production is on the both on the weeklies and on the monthly numbers, there's different things that count as crude oil according to the DOE. So there's this strict crude oil production number, which is this chart here on the left. On the right is sort of the effective crude production number. So this includes adjustments. So again, when supply and demand don't match the change in inventory, they have an adjustment number to bridge that gap. But they've also realized that the market is injecting NGLs into the crude stream and fluffing up the crude production number a little bit. So as various NGLs have relatively low values, imagine putting a little bit that back into your crude oil, and that's fluffing up your volume, and then you're able to sell it instead of 20-30 bucks per barrel, you're able to sell it at 60-70 bucks per barrel. So I mean, that seems like as long as you're within tolerance of your contract and you're not breaching anything like that, it seems like something that makes good business sense to do. That's what this chart over here is meant to sort of show you. So what I did, because the crude production number is so big, I just gave you the change in crude production, which is the blue number here. The orange is what we call the transfers. So that's NGLs being transferred into the crude stream, which is always a positive number. So this will always be on the high side of the x-axis here. And then the gray areas are the adjustment numbers, which I spoke about, which is just a mathematical number which goes on there to say, well, maybe our production number was off a little bit, or the demand number was off a little bit. But that's what helps bridge the gap between the change in inventory versus what the supply and demand components would give you there. So that's a quick explanation of that. And then when you add the NGLs back to the crude production number, so it's kind of, now we've erased this sort of transfers number, right? And now we're looking at all NGL production plus all crude production. That's actually really quite high as well, and pretty far above year-ago levels. So, as bad as we've been talking about prices and the outlook for producers and that sort of thing, given the current price levels, this year we have seen production growth. We are at new production record numbers on both the crude oil and crude oil plus NGLs as well. So just to recap really quick, of course, the OPEC 8 announced 137,000 barrels per day coming back on the month of October. Again, my thoughts on just the market in general in the near term, September, October, is relatively bearish. And that the more bearish we are now is almost more bullish next year, next summer, for the heat of summertime. So maybe take that into consideration. That's the way I'm thinking about it anyway. We did get back to the support line. I think that's now in jeopardy with this announced production increase. We'll see. I think it should be interesting. Again, I think 55 is still in the cards. It's still a possibility in the near future, meaning, again, maybe this week, but maybe we have to wait a little bit longer for inventories to build due to turnarounds and that sort of thing. June demand numbers looked really strong. Exports down, but domestic transportation is at the top of the 5-year range. Cushing stocks in Pad 2 outside of Cushing are building pretty quickly with the turnarounds going on, and then the high production numbers that we talked about previously. So hope you find that interesting. Please like and subscribe to our channel. It really does help quite a bit. And if you want a more detailed explanation about all this sort of thing, please go to our website, theoilbalance.com, and you'll see a button that says to add me to your distribution list or give me a free trial. Please click on that. Send me a quick little, it'll go through a thing to send me an email. Please let me know that you want to get on that distribution list, and you'll get a much more detailed explanation than I can give in these short videos. All right. So hope you have a good trading week and talk to you later. Bye.